In this lecture, we will study foreign exchange exposure and international capital budgeting. These topics connect currency movements with corporate cash flows, accounting results, strategic competition, and investment value. Foreign exchange exposure is not simply the possibility that a currency may rise or fall. It is the sensitivity of the firm to unexpected exchange rate movements. The word unexpected is essential. When a currency change is already anticipated, firms may have adjusted prices, contracts, financing plans, and discount rates. The real risk appears when outcomes differ from the assumptions built into those decisions. Throughout the lecture, think of the exchange rate as the amount of home currency required for 1 unit of foreign currency. When that rate rises, a foreign currency receivable becomes more valuable in home currency terms, but a foreign currency payable becomes more expensive. The same movement can therefore help one firm and hurt another. Exposure can arise from importing, exporting, foreign borrowing, overseas subsidiaries, global suppliers, or international investments. Even a domestic firm may be exposed through foreign competitors. Our goal is to identify each form of exposure, understand how it affects value, and connect risk management with disciplined project evaluation. Let's begin with the three major forms of foreign exchange exposure: transaction exposure, translation exposure, and economic exposure. Transaction exposure concerns foreign currency cash flows that are contracted or highly probable. The central question is what happens to receipts and payments when exchange rates change before settlement. It is usually the easiest exposure to identify because it is tied to specific receivables, payables, loans, purchases, or sales. Translation exposure concerns accounting. A foreign subsidiary may prepare its statements in local currency while the parent reports in another currency. Exchange rate movements can change consolidated results, even when local operations have not changed. Economic exposure is broader and longer term. It asks how currency movements affect future sales, costs, margins, market share, investment returns, and competitive advantage. It is often the most important exposure for firm value, but also the hardest to measure. We can also classify exposure by mechanism. Cash flow exposure changes specific receipts and payments. Accounting exposure changes reported values. Competitive exposure changes prices, demand, sourcing costs, and competitor behavior. These categories overlap. A company may face all of them at once. Classification is useful because each channel requires a different managerial response. Before choosing a hedge or changing strategy, managers must understand exactly how the exchange rate reaches the firm. Transaction exposure arises when a foreign currency cash inflow or outflow will settle in the future. Common sources include receivables, payables, debt service, purchase commitments, export sales, import purchases, royalties, license fees, and intercompany payments. The first task is to measure net exposure rather than looking only at gross amounts. Inflows and outflows in the same currency with similar timing may offset one another. A positive net position means the firm is long the foreign currency, so appreciation increases its home currency value. A negative position means the firm is short, so appreciation makes settlement more expensive. The expression shown in the background separates the amount of currency exposed from the exchange rate movement. This makes the sensitivity easier to understand. Transaction exposure affects liquidity as well as value. A contract may remain profitable, yet still create a cash shortage if currency movements increase near-term payments. Management tools include currency matching, invoicing choices, payment timing, price adjustment clauses, and financial hedges such as forwards, futures, options, swaps, and money market positions. A hedge changes the pattern of cash flows. It does not erase the underlying business exposure. A forward can protect a known home currency value, but it also removes favorable currency upside. Good policy, therefore, begins with careful measurement and risk tolerance, not with a confident prediction about currency direction. Translation exposure appears when a parent company converts a foreign operation's financial statements into the parent's reporting currency. The subsidiary may conduct business and keep its records in local currency. During consolidation, exchange rate movements can alter reported assets, liabilities, revenues, expenses, equity, and profitability ratios. This can happen even when production, sales volume, and local operating performance are unchanged. A useful way to understand the direction of the effect is to focus on the subsidiary's net asset position. When foreign currency assets exceed foreign currency liabilities, depreciation of the foreign currency reduces the translated value of net assets. Appreciation increases it. The relationship displayed in the background summarizes this sensitivity. Translation effects are not necessarily direct cash flow losses. A lower translated value does not mean cash disappeared. It means the amount reported in the parent's currency changed. Still, translation exposure can have economic consequences. It may influence reported leverage, growth rates, debt covenants, credit assessments, compensation plans, board evaluation, and investor communication. Accounting treatment depends on reporting standards, functional currency, and the nature of the foreign operation. Managers should separate operating performance from translation effects and explain both clearly. The right response is not automatically a hedge. Sometimes, better disclosure and performance measurement are enough. Hedging becomes more compelling when accounting volatility threatens financing access, contractual limits, or managerial incentives. Economic exposure is the sensitivity of the firm's value to exchange rate movements. It reaches beyond existing contracts and focuses on future cash flows. Currency changes can influence revenues, costs, margins, market share, investment opportunities, and strategic flexibility. Economic exposure may therefore be more important than transaction exposure, even though it is harder to observe. A company does not need a foreign currency receivable or payable to face it. Consider a domestic producer competing with imported products. When the home currency strengthens, foreign competitors may be able to lower domestic prices while preserving their own margins. The local producer may lose sales, cut prices, spend more on marketing, or accept lower profitability. The exposure comes through competition, not through a foreign currency contract. A key concept is exchange rate pass-through. This describes how much of a currency movement appears in product prices. When pass-through is high, customer prices adjust quickly. When it is low, producers and suppliers absorb more of the movement through margins. Pass-through depends on competition, product differentiation, contracts, customer behavior, and supply chain structure. Economic exposure cannot usually be eliminated with a single derivative. A financial contract may hedge a known payment, but it cannot fully hedge future market share, pricing power, sourcing flexibility, or competitor behavior. Managing this exposure requires strategic choices about operations, pricing, markets, product design, sourcing, and where the firm produces and sells. Natural hedging reduces currency exposure by aligning the currencies of revenues, costs, assets, liabilities, and financing. Unlike a standalone derivative, a natural hedge is built into the firm's operating or financing structure. A company may borrow in the same currency as its foreign cash flows, source inputs in the currency of its sales, finance local assets with local currency debt, place production closer to customers, diversify revenue across currency regions, or include exchange rate adjustment clauses in long-term contracts. Natural hedging can reduce exposure at the source, but it is not free. A local supplier may lower currency risk while charging more. Local financing may improve currency matching while offering less attractive terms. Foreign production may reduce competitive exposure while increasing fixed costs and operational complexity. Managers must compare the cost of the hedge with the risk reduction it provides. Operational flexibility adds another layer of protection. Flexible sourcing allows purchases to shift among suppliers. Flexible production allows output to move among plants. Pricing flexibility supports margins. Product differentiation gives the firm more control over customer prices. Geographic diversification can offset weakness in one region with strength in another. This flexibility is especially valuable when economic exposure is uncertain and long-term. A static hedge protects a defined position. Flexibility helps the firm adapt as conditions change. The strongest natural hedges are those that support both risk management and business strategy. International capital budgeting applies the same core principle used in domestic project analysis. Accept a project when its incremental, risk-adjusted cash flows are worth more than the required investment. The international setting adds complications. Cash flows may arise in different currencies. Inflation may differ across countries. Taxes may apply at both subsidiary and parent levels. Political risk, capital controls, financing choices, and restrictions on remittances may separate local project value from parent company value. The central question is not simply whether the foreign operation earns a profit, it is whether the project increases the value of the parent company after currency, tax, financing, and country-specific risks are considered. The valuation equation shown in the background combines the initial foreign investment, expected remittable cash flows, exchange rates, discounting, and terminal value. E. The structure is familiar, but the assumptions require discipline. Cash flows should first be forecast in the currency that best reflects the project's operating economics. For a local project, that is often the local currency. The forecast should include sales, operating costs, tax depreciation, taxes, working capital, capital expenditures, reinvestment needs, and exit value. Most importantly, distinguish subsidiary cash flow from parent company cash flow. Cash generated locally may be retained for operations, used for local debt service, shared with minority owners, taxed, delayed, or legally restricted. Only cash available to the relevant investor should drive that investor's valuation. An international project can be valued in two equivalent ways when the assumptions are internally consistent. One approach is to forecast foreign currency cash flows, convert each expected amount into the parent's home currency, and discount the converted cash flows using an appropriate home currency rate. The other approach is to keep the cash flows in local currency and discount them with a local currency rate that reflects the same project risk. The resulting local currency project value is then converted into home currency at the current spot rate. The currency of the cash flows must match the currency of the discount rate. It is a mistake to discount foreign currency cash flows with a home currency rate before conversion. It is also a mistake to convert cash flows into home currency and then apply a foreign currency rate. Both choices mix incompatible inputs. Consistency also matters within the forecast. Local sales and costs may react differently to inflation and exchange rates. Imported inputs may be tied to another currency. Taxes depend on local rules. Working capital may be trapped in the host country. Terminal value may be received in a different currency or reduced by exit costs. The two valuation approaches should lead to the same conclusion only when exchange rate expectations and discount rates tell a coherent economic story. Without that coherence, apparent precision can be misleading. Inflation, exchange rates, and nominal discount rates must be analyzed together. A nominal cash flow forecast includes expected price and cost inflation. A nominal discount rate also includes expected inflation. When countries have different inflation expectations, their interest rates and currency values may follow different paths. The relationships shown in the background include the Fisher relation, purchasing power parity, and interest rate parity. These are not perfect forecasting machines. They are consistency checks. Purchasing power parity suggests that a currency with persistently higher inflation tends to lose value over time. Interest rate parity connects spot rates, forward rates, and interest rate differences. International projects also face political and country risk. These may include adverse regulation, expropriation, contract disruption, corruption, civil unrest, sanctions, tax changes, sovereign stress, weak legal enforcement, and restrictions on trade or capital movement. Tax analysis may involve local income taxes, withholding taxes, duties, transfer pricing rules, and parent country effects. Repatriation risk arises when local cash cannot be moved to the parent when needed. Convertibility risk arises when local currency cannot be exchanged freely. These risks may be reflected in expected cash flows, discount rates, or scenarios. The analyst must avoid double counting. When a potential loss is already included in probability-weighted cash flows, Adding another adjustment for the same event may understate project value. Let us bring the entire analysis together with a disciplined decision process. Begin by defining the perspective. Are we valuing the project for the subsidiary, the parent company, or both? Identify the currency that best represents the operating economics. Estimate only incremental cash flows caused by the project, including taxes, working capital, reinvestment, side effects, and terminal value. Next, separate cash generated locally from cash that can actually be remitted. Check whether inflation, price growth, cost growth, exchange rate expectations, and discount rates are mutually consistent. Choose a risk-adjusted discount rate that matches the currency and risk of the cash flows. After the base valuation, run scenarios. Examine currency movements, cost inflation, demand weakness, tax changes, political disruption, and remittance delays. Compare financial hedges, natural hedges, local financing, contract design, and operational flexibility. Remember the main principles. Measure exposure before managing it. Distinguish cash flow risk from accounting volatility. Treat exchange rate forecasts as assumptions, not certainties. Keep currencies consistent. Do not ignore long-term competitive exposure. And do not count the same risk twice. Foreign exchange risk is not automatically bad. A firm may accept it when expected return, strategic benefit, or natural offsets justify the uncertainty. The goal is informed risk-taking, not the elimination of every fluctuation. Thank you for joining me today. I hope this lecture has made foreign exchange exposure and international capital budgeting clearer and more practical.